So the market is getting better, and if you are thinking of putting new investments into the United States, timing is very important, and this is an important time to be considering that. Actually, I should say you're a little bit late in considering that, because what we're finding is that that the capital markets have already started to move ahead of the fundamentals markets. And in fact, capital prices, yields, or cap rates, as we discuss it in the States, have already come down a little bit because of the competition for core real estate assets. And what we're finding is that there's a number of bidders looking for those core assets, and what we're finding is that prices, as I mentioned, are rising, or cap rates are falling. So everybody wants risk-free, stabilized core assets in the States, and we're finding that that the best time actually to have been in the market was last year, not this year. That said, there's still a lot of opportunities as we see it. But let me come back again. Let me talk about some of the things that I'm sure you're reading about. We still have a lot of distressed debt. There is continually to be increases in the amount of properties that are distressed, but at the same time, the amount of properties that are getting resolved is greater than the amount that is being added to the distressed pile. So we're starting to see recovery in that category. Also, we're starting to see increases in the volume of transactions in the United States. Currently, U.S. volume of investment transactions are running approximately $20 billion a quarter. Now, this is up over the $10 billion a quarter we had a year ago, but it's nothing compared to the $100 billion of transactions a quarter we had back in 2007. So again, we're off the bottom. We're certainly not back to any of the previous levels. Credit, we're finding that credit is available in the States. At ULI, there are many lenders talking about their standards, or what they were looking for in terms of putting out some money. One very major firm, if I mentioned their name, you'd all know it, said they had $5 billion that they wanted to put out this year, and they were thinking that it was going to be impossible to do so. Their terms is they need coverage of 1.15. They need a loan-to-value ratio of 65, and they'll give you money at 4 to 5%. So credit seems to be available. Again, the issue for many of those who bought real estate assets in 2006 and 7, and I know that there was a number of you from Australia that were doing that in those years, have assets which are underwater by approximately 30%. So there's still that problem, that issue that is lingering in the United States. So I guess the best way to kind of describe it, though, is that we're off the bottom. We still see the time that it's going to take to get back to levels that were in existence in 2007 is going to be extremely long. And so for those who invested in the mid-2000s, recovery is going to be a long period. For those who have dry powder, this is clearly an opportunity, and this is a time of opportunity, but timing is, in my view, very important. There's an old quip, you know, that the difference between salad and garbage is timing, and I think that also applies at this moment in real estate. I think that sort of hits some of the key points that Kevin wanted me to mention to you. So I'm going to turn it back to Kevin, who's going to talk to you, I think, a little bit more about what's going on in Brisbane and what's going on across Australia. I wish you all a very good day. Thank you very much.
Okay. Thank you, Ray. All the way from Boston, just recorded last Friday evening.